If you've ever sold credit spreads only to have lots of gains wiped out by a single large losing trade, then this video is for you. We're going to look at how to protect your gains from that big loser that you know is coming, and we're starting right now. All right, let's get started. We're going to look at just a few slides here real quick just to kind of, summarize up what we're going to be looking at. We're going to look at the backtest software. We're going to look at this in Thinkorswim so you can see what this trade looks like on how to set this up. But essentially what we're trying to do is hedge our long positions, when we need it. We know that you can, carry a hedge and you might see the term something like crisis alpha. And some people like to hedge with VIX call option futures. This is going to be a little bit different. We're going to trade the same instrument. We're going to hedge the same instrument that we're trading. So for example, I trade a lot of SPX put credit spreads, and I've been trading call spreads, and I always find myself defending the call spreads. So this is a different way to hedge those positions. But the key here, and it's something I've been trying to figure out, if you will, is how to only hedge when you need it and how to define that so we know when do we put on the hedge instead of just carrying the hedge every month or every week or whatever. That takes away from your profit. So we're going to explore how to put the hedge on only when you need it. It's going to be a low cost crash protection when we need it. So before we get into those details, quick disclaimers, presentations for informational purposes only, should not be considered investment advice. I am not a financial advisor of any kind. I'm just a regular retail trader. Options can be risky. You should know that already. If you're watching this video, they're definitely not suitable for everyone. You can lose all of your money trading options if you don't understand how they work. Now, this is the vertical spread channel. We're going to be talking about vertical spreads, so we are defining our risk with this trade. Past performance of any strategy is not indicative of future results. And the backtesting results we're going to look at towards the end of this video, this presentation, are showing theoretical returns from end of day option pricing. Just want to throw that in there. So this strategy I've come up with to hedge my own trading. So it's really designed to be coupled with my SPX SPY 60 DTE conservative option strategy. If you want information about that strategy, you can go ahead and check the description on video. I'll put a link over to that article or that video. And basically where I'm selling far out of the money put credit spreads on the indexes, I trade SPX mainly. It's kind of an income style trade, but we all know the high probability trades, at some point the market dips and the losers can be a lot bigger than a bunch of small winners. So this trade is meant to hedge that and minimize those losses when that dip finally comes. You can also use this for general portfolio protection. If you have a bunch of different trades that are somewhat correlated to the S&P, and you have to figure out your own beta weighting and stuff on your own, but you can use this to protect a regular portfolio if you want to. In general, we want to help protect our put credit spreads. That's what we're going to be focused on in this video, kind of a crash protection, but again, only when we might need it. Ultimately, we are looking to avoid large drawdown from big dips in the market so we can avoid wiping out months of gains in one giant loser kind of. Which is very common when you're selling high probability credit spreads. I'm sure you've experienced this before. And that's really how options are designed. You might be trading an 80% probability trade, but the one or two times that it goes against you, it can wipe out a lot of the small winners. So again, we're trying to hedge against that scenario. So let's go ahead and just look at exactly the strategy. Here's how you're going to do the strategy. Here's it is, and then we'll look at the results and what it looks like. I want to give you this information up front. We're going to look at the SPY version. It is slightly different from the SPX version, but let's talk about SPY. So the entry of the trade, and just imagine that you have a bunch of long positions on, or maybe you got put credit spreads on. What we're looking for is when the market starts to show signs of pulling back. And basically, this is no genius comment here. When the market is bullish, at some point it's going to turn. And what we're going to define as the turning point is a close or a cross below its 10-day simple moving average. So think of the market, rallying and, grinding higher forever, it seems like. When that market finally closes below, crosses back down below, you can imagine a 2, 3, 4 day pullback. That could be the start of a bigger move lower. That's the moment we want to put this trade on. And the trade, we're going to be looking at buying a 60 DTE, 60 days to expiration, so it's 2 months out, a delta 5 4-point strike with put debit spread. What does that mean? And we're going to look at a detail in the option chain here later in the video, but basically you're going to go to the option chain, and for whatever 60 days to expiration it is, I'm using weekly options too, because they have weekly options 2 or 3 times a week, and you can find something close to 60 days to expiration. And you're going to find the delta 5 put, which is way down on the scale, and you're going to go 4-point strike wide. So let's, for example, if you found the 289 put, it was delta 5, then we would go 4 strikes below that. So 289 minus 4, you would be buying the 289 and selling the 285. That would be just kind of an example here. So there's 3 exits to the trade, and let's talk about what this means. Exit number 1, there's a 300% gain on the cost of the spread. So when you're buying a put debit spread, and let's say it's 50 cents or something like that, when you get a 300% gain, so when their $50 turns into $200, that's a $150 gain, that's a 300% gain, you'd want to exit the trade, because in order for that to happen, there has to have been some kind of big dip. That's your crash protection. It's not going to cover every dollar that you have in your long portfolio, but it's going to severely minimize that drawdown. So exit number 2, we're going to put a 25% stop loss on the cost of the spread. So again, the $50 example, if you buy a $50 spread and it loses, let's say 10, 15 cents, then we're going to exit the trade. And think about that. If the market dips below the 10-day moving average and it's just a short-term buy the dip situation and the market goes back up, this spread's going to lose value. So instead of carrying the hedge and letting it go to zero, if the market rallies back up, you're gonna cut the trade at 25% stop loss. So let's say $15. That would probably mean that the market goes back above the 10-day moving average in most cases. And then if it closes back below, you just put on a new one, right? So we're not gonna hedge using the entire amount. We're not going to let it go to zero. We're going to exit the trade if it's not working, and that's going to be defined by a 25% stop loss. Exit number 3 is we're going to exit the trade 30 days to expiration. So think about that. If you're buying a 60 DTE put debit spread, if in 60 days the market's just kind of chopping around and you haven't hit the stop loss and you haven't hit the max gain, we're just going to close the trade and take the hedge off, because obviously the big move didn't come. And when the big move comes, you're going to get another opportunity to put that trade on. And if you can define it yourself. If you feel like the market could still, you could always just go put on another one. And we'll look at the results here in a minute, but this is designed to keep you from wasting money every month on a hedge and really just buy the hedge when you need it. So let's look at the SPX version. It's very similar. Same setup. When the SPX crosses below its 10-day moving average, we're going to buy a 60 DTE. Again, delta 5. So we're going to find the delta 5. We're going to do a 20-point strike width on the SPX. A lot of times this is 4 strikes, depending on the expiration. Sometimes you'll see $5 strikes. Sometimes you see $10 strikes. But it's going to be a 20-point strike width for this game. SPX, the backtesting showed that 400% gain actually did slightly better. So in this example, if you're buying a SPX 4-strike put debit spread, a lot of time the cost of this is about $70 or $80. So it's pretty cheap. Let's call it $80 for now. If you buy it for $80 and you get a 400% gain, basically you would multiply 80 times 5. You end up with $500. That would be, I think that's right. Correct my math in the comments if you want. I'm doing this without the calculator, but you get the point. You're going to exit that trade if it hits $400, I believe it is. So again, same stop loss, 25% stop loss. So if you have the $80 trade and you put on $80 put debit spread, and the market starts to rally back up, it's going to hit $60 would be about where your stop loss would be, and you would exit the trade. And again, we're going to exit the trade with a time stop. If neither one of those things happen, exit 1 or 2 don't happen, we're going to exit that trade after 30 days. We don't want to carry this into the last expiration, because theta picks up. You're going to get stopped out anyway, and it isn't the hedge effect of the crash is going to be kind of diminished there. So that's basically the setup. So let's go ahead and dive into the trading platform to see what this actually looks like. All right, so we're going to do an example in SPX because that's what I primarily trade. And what I have on here is the 10-day simple moving average. And just, let's just ballpark this with our eyeballs, right? So when the market's rallying, then you don't really need to hedge, right? Because we're waiting for the market to close below because that's going to be the beginning of whatever potential big move there is. So we've had a lot of false signals, if you will, and that's okay because the hedge is so cheap and we're getting out so quick that it doesn't take away as much profits as the actual put credit spread trades we're going to be running each week. So in this case, you had a dip here. This is where you would put on the hedge. A few days later, the market rallied. You'd probably be stopped out of that 25%. It dips again. It's going to rally. This is a very low probability trade, but it's like swinging for the fence. It's low probability, and then you get a big winner when the market finally dips. And we're going to take a look at that, and you'll see that in the P&L curve here in a second. Eventually, this signal turns out to be pretty good, right? So in this case, if we zoom in here, we had a close below, we put on the trade. If you got stopped out here, you would just simply re-enter here. So we'd have to see if that actually caused a stop out. But you had this big dip. So this trade's going to make money here. And that's going to allow you to stay in your put credit spreads a little bit longer, so you don't have to necessarily put stop losses on your put credit spreads, which I don't do anyway. But if you had spreads way down here and you're able to hedge this on the way down, your unrealized P&L is not going to be that bad, and you're going to be able to stay in that longer and let time play out, because that's ultimately what we're playing for here with our longer positions. Market rallies back up. Same thing, got another close below, maybe you get stopped out here, and then boom, huge dip. And that's the general idea of the setup. It's very simple. You're looking for a cross below, you're trading above the 10 SMA, and you close below. And that's really all the hedge trade is looking at. So currently the market is way above it, so we're not going to have any signal anytime soon, or at least in the next couple days probably. But let's go ahead and look at the option chain on how to set this up. So again, once the 10 SMA crosses below, or the price crosses below the 10 SMA, we're going to look out to the 60-day expiration. So in this case, I already have some, I got a spread on here, but I would look for the lowest 60 days. I wouldn't go in the 50 just to be consistent with the back test. So we're going to open up, if it was today, we would open up the February 21st expiration, has 64 days. That's fine. We're going to scroll down. You can see I have the delta column over here. We're looking for a delta 5 option. So what I like to do is find, and you're going to see that there's multiple delta 5s. I usually try to find one if it's near a quarter strike, for example, the 2775 or the 2800. That's a delta 6. I'm okay with just kind of going in between for now. A lot of times I want to see where, if there's better liquidity, I may choose a different one. So delta 5, there's a few. There might even be some more. Let me put it in here. That's way down there, isn't it? So we actually have 1, 2, 3, 4, 5, 6, 7, 8 delta 5. So it's really your choice. So in this case, I would probably choose the 2775. The fill here is going to be a little bit easier, maybe not on the sold strike. So we're gonna buy a 20-point wide put credit spread. I'm sorry, put debit spread. I keep saying that. So the way I do this is, and since they're half strikes and they're $5 strikes, I'm going to right click and I'm going to buy a deep and wide 1 month 4-strike vertical. That's going to give us, let me lock that price for a minute. I am making this during the trading hours, so these prices are pretty accurate. The 2775, and we're buying that, and we're selling the 2755. It's about 64 days to expiration. And this is a 20-point wide spread. And the moment this is going to cost 60 cents. The reality is you may need to bump it up to 65 to get filled because there's not a lot of volume down here. So, and you also may need to just sit on it for a couple, like a day or a few hours. These things do not get filled instantly, and that's okay. But we're going to go with the 60 cent example. So this is how much that hedge costs. It's for this particular month. Now vol's super low, so it's a little bit cheaper, but it's it's $60. So if that value of that spread if the market were to rally back up and it drops down to 45 cents, then that would be your 25% stop loss. Okay. Now what we're going to do is let's go over and we're going to analyze the trade. And I want for you to conceptually understand what we're trying to do here. What we're doing, we're buying this crazy put spread way down here. The market at the time of this video is trading just around 3,200, just under 3,200. We're hitting all-time highs again. What we're basically doing is adding negative deltas. So if you're selling put credit spreads or you're long in whatever fashion, you're going to have a lot of positive deltas. So this is a cheap way to pick up some negative delta and cut it short when it doesn't work. So you can see the purple line is sort of the today line. And for our example, we would look to get out of this trade if the value of the spread increased to 400% gain. So if we do 60 times 5, that's $300. That would be a $240 profit. So think about that. And we're not even counting an increase in Vega. So if the market sells off, volatility is going to increase, and this purple line is going to go up. So you're going to make more money faster than what we're seeing right now. So that's another sort of built-in bonus is you're adding positive Vega, meaning if volatility increases, you're going to make money. So right now, let's forget about Vega. Let's just look straight Delta. We're at 3,200. If the S&P lost 200 points, you would be up on this trade. I want you to think of whatever position you're in right now. Maybe you're in some put credit spreads, maybe you're long Apple, whatever. If the market lost 200 points, what are you going to do? How much are you going to have lost, right? So that's what we're trying to protect against, the crazy, tweet or whatever that comes out that's just going to send the market lower. This trade is going to give you some negative delta for very low cost in case that crash happens. So count Vega here. We would probably hit our max target. I'm going to say somewhere between 2,950 and 3,000 on the SPX. So this is going to hedge us. I'm going to call it 200 points just for sake of argument. So 200 points. So let's look at a put credit spread I have on that's very high probability. And we're down here at 2,950. And it's pretty much the opposite trade, right? I've sold a put credit spread down here. So now I have a massively negative delta. I'm sorry, positive delta, meaning if the market sells off, I'm going to lose money. And when I combine these two, my delta gets close to zero. So by adding this hedge trade when it's necessary, I'll be able to hedge my long portfolio. In this case, I just have one spread I'm showing. And we would basically, if we lost 200, 300 points, 250 points, I would not be down in my account. And that's the whole point, is to avoid the large drawdown. If the market lost 1,000 points, I'm actually going to make money because this hedge is going to, we saw the max gain. If for some reason the market we woke up and it was 1,000 points lower, it would actually make money. That's probably not going to happen. Very low probability, but it helps you sleep better, right? So basically what we're doing here is we're putting our put credit spreads into a delta neutral. And this is outside the context of iron condors and all that stuff. I'm not even trading the call side. In fact, I'm questioning whether I should ever trade the call side again. I've had so much trouble with those. I know a lot of you guys have too. But this is what we're trying to do. We're going to get delta neutral, if you want to call it that, and delta hedge. There's a lot of terms for this: crisis alpha, delta hedging, getting delta neutral. By adding that spread, here's my put credit spread. By adding an 1-to-1 here, by adding one spread, I'm getting delta neutral. I can make money. Ideally, the market would crash 100, 200 points. I would get out of my hedge trade, and then if the market rallied back up like it usually does, then I would actually make money on both trades. So that's the general idea. If for some reason I got out and the market kept going and I was able to minimize the max loss on this, then that would be avoiding the large drawdown that we had talked about. So that's essentially the trade. This is what it looks like. We're buying that far low probability trade, and we're adding some negative delta. So now what we're going to do is look in the backtest results over the past 10 years and how this trade has worked. All right, so I'm logged into eDeltaPro. This is the backtesting software I'm using for this particular study. I'm going to put a link in the description on YouTube if you guys want to do this, the software yourself. You can get a free trial. You can kind of test it out. You basically have all these different backtests, and they kind of look like cards. So we're going to dive into this one, the SPX 60 DTE hedge trade, 10 SMA cross below. And you see I have a bunch of other things I'm working with here. So we're going to go into it, and let me just kind of show you how this was set up. And basically, we're doing we're going to be long a put spread on SPX delta 5 minus 20. That means it's a 20-point strike width. That's what that looks like in the back test. Put this back to delta 5. 60 days to expiration. Here are my 3 exit targets: 400% max profit, 30 days to expiration, or 25% stop loss. Once we're out of that trade, we're not going to reestablish the trade until the trigger happens. In this case, it's the stock crosses below the 10 simple. And we're doing sequentially, mean we're just going to wait for that signal, and then we just kind of wait. So let me go ahead, and it's already run, but let me run it real quick, and let's just look at the results. And I think the interesting thing here is going to be the P&L curve, because if you think about put credit spreads, for example, you're going to have a bunch of small winners and then you have one big loser, right? Well, this is the exact opposite. It actually made money. This is a 10-year look back, right? It's only profitable 6% of the time. So most of the time it loses money, right? And this is the exact opposite of selling put credit spread. Usually you get a bunch of little winners and you have the one big loser, right? It's the opposite here. You get one big winner and you got a bunch of little losers. And here's what the P&L curve looks like. So we're incrementally losing money as we get those pullbacks, and then a big dip happens and we get a large gain. That's the hedge. You're gaining when the dip happens, which is going to hedge your other positions. And then for years, you're losing money on this trade. It's not that many trades, though. When you're trading, if you think about trading a put credit spread every week or every month, this one's only putting on, let's see, we did 48 trades over the last 10 years, right? So 48 trades. So how many is that? 4 or 5 times a year, something like that you would do this trade. So you're not really losing that much. In fact, when the Christmas bear market, or whatever you want to call it, that last year, you actually recouped a lot of those losses. So again, it's the exact opposite of selling a put credit spread, where you have a bunch of losers and then you have a couple big winners that wipe out all your losses. And if I replace that with credit spread, you'll say you have a bunch of winners and then you get to the point where you have a 1 or 2 losses that wipe out all your gains. So again, these are meant to go together. Since you're doing this kind of in a situational, context of just when that market closes below the 10, then you're not trading it as much. So you're going to have a lot more winners on the other side, and you'll be able to hedge those bigger losers. So the results are pretty similar with the SPY. I trade SPX. So again, if you want to learn the 60 DTE put spread trade that kind of goes along with this, check out the description below. If you have any questions, feel free to comment. I would love your feedback on this. This isn't the only way to hedge yourself, but I found this is a pretty easy way to hedge a ticker you may already be trading. Thanks for watching, sharing, and subscribing, and we'll see you at the next video.